have with us Pramod Gubbi, the founder at Marcellus Investment Managers, joining in on the show right now. Pramod, hi, afternoon. Welcome to ET Now. Pramod, there's quite a divided opinion out there. A large part of the market participants do believe that this is not it. It's not just about life highs, but we're going to see newer highs from even the current juncture. And then some are getting a little edgy about the market valuations, and they believe that in the near term, this is the best it's going to get, and it's getting a little toppish. How are you reading into the market mood right now?
Hi. Thanks for having me here. No, I mean, short-term movements in the markets are always unpredictable, given that you tend to be driven by multiple factors not within anybody's control. Right now, clearly, the market is in the grips of FIIs buying into it. So for you to extrapolate that, you'll have to make a call on whether foreigners will continue buying or not. From the looks of it, there is a case for FIIs to buy, but particularly starting with the fact that interest rates seem to have peaked out, or at least are closer to the peak than any other time. To that extent, money tends to flow from the developed markets to emerging markets, particularly to risk assets like emerging market equities. And if that's likely to hold true, that should continue to mean that foreigners will continue to buy. And secondly, I think given the geopolitical situation globally, India clearly is set to get a larger than normal share of its flows coming into emerging market equities. And that means that we will see this sort of momentum. I think they've bought in about $8 billion compared to the $30-odd billion they sold between October 21 and March 23. So they'll likely come back much more strongly over the coming months. To that extent, it is quite possible. It is quite possible that we will overreach in terms of valuations. But the market never goes up in a straight line. It always exceeds on either side of the equilibrium. But having said that, I think if you take a relatively long-term view, there should be enough support in terms of earnings growth coming through. There are several drivers for it, starting with the banking system, ready to provide credit support to the industry. We're finally seeing an investment cycle in the country with private capex picking up. To that extent, you will see knock-on effects, both in terms of earnings from the industrial sectors, which haven't participated for the better part of the last decade. And that will have its own knock-on effects in terms of job creation, income generation, which eventually will benefit consumption as well. So from a domestic economy perspective, I think there's plenty to look forward to in terms of earning support, which should mean that these flows can be digested, provided you take a relatively long-term view.
Fair enough, but then this capex theme, the private capex theme, how are you playing that at Marcellus? Which are the stocks or sectors that is a buy at this point of time?
Well, at this stage, we're playing it largely through financials. In any case, we are a bottom-up house. We prefer to buy best quality stocks. If it fits into a macro theme, well and good, but otherwise we don't necessarily play a theme for the sake of it if we can't find good companies within that. And when we say good companies, we'd like to see good governance, good capital allocation, and some sort of a sustainable competitive advantage. We are working on it. We are looking at sectors such as electronic manufacturing services, defense, specialty chemicals has always been part of the China Plus One story. So these are some of the sectors which are likely to get some of the benefits of the rearranging of the global supply chain. To that extent, obviously, we're looking for opportunities there, but we will take a position only if we believe from a bottom-up perspective, the specific company in question meets those criteria.
Within financials itself, how are you playing that? Are you sticking with the large caps, the likes of HDFC Bank, etc., which has been a favorite at Marcellus, or is it getting a lot more diverse and there are newer names that are also forming part of your portfolio now?
Well, we do have a dedicated financials fund. To that extent, beyond our flagship fund where we own HDFC Bank, Kotak Bank, and Bajaj Finance, we do have some NBFCs in the financial specific fund. To that extent, we are exposed to some of the cyclical uptrends that we've already seen in terms of the credit cycle picking up. But we've always stuck to lenders who have a very strong liability franchise, because mind you, in an upcycle, it's very easy to grow your loan book. But unless and until you have some sort of an advantage on the liability side, which keeps your cost of funds very competitive, you can grow your loan book without taking undue risk, which will come back to haunt you if you haven't taken care of that at the fag end of the cycle. Because eventually, every cycle will have to see an end to it. At the end of it, you will have some assets, some NPAs coming through. So for us, more than your ability to lend, it's your ability to keep cost of funds under check, which is more important, which is where HDFC Bank takes the book. You've seen deposit growth growing almost double the rate of the system, even at the scale that HDFC Bank is. Part of it is, of course, necessitated by the fact that they have to replace liabilities of HDFC Limited, with which they're going to complete the acquisition later this month. But in general, it demonstrates the strength of the liability franchise, and that remains the number one focus for us while selecting lenders.
Right.
Okay, Pramod, point taken. But just before we head into the break, I had a quick question about HDFC Life, because that's also part of your portfolio. And we were just speaking with Vibha in the morning. She sounded quite confident that despite the tax changes, there's a long runway of growth available. Is that your view as well? And why only HDFC Life?
No, absolutely. I would to agree. Life insurance penetration is pretty low in this country. Mostly life insurance has catered to the savings side of the industry. We haven't really tapped very well into the protection side nor the annuity side. I think the tax arbitrages are a thing of the past. With that gone, you have a one-off impact, which is all the more reason why we choose an insurer like HDFC Life, because historically it has depended less so on such savings products compared to the rest of the industry, particularly very little exposure to ULIPs, but has invested in developing a brand which is very, very important when it comes to pure term insurance or annuity products, because your savers or your insurance customers are taking a bet on your ability to furnish the claim when it's due, or your ability to service the annuities when you retire and need that capital most. So the brand is strong. The distribution has been fairly impeccable, particularly having a direct distribution arm. And finally, in terms of product innovation, HDFC Life has led the way. And also in terms of use of technology to create leverage in the business. So we're quite positive, and we do agree that the growth runway for life insurance is pretty long in India. And within that, we find HDFC Life ticking most of the boxes.
Okay, Pramod, just hang in there. Lots more to talk about, and we are also going to play out Vibha Padalkar from HDFC Life soundbite on the margins, guidance, where they see growth coming in from. But I would just like to thank as well our chartists for joining in on the show right now. Meghna, thanks a lot for taking the time out. We'll see you again soon. We'll take a very quick break, come right back. We'll continue our chat with Pramod Gubbi and, of course, bring in a whole host of other experts as well.
Yes, there will always be pressures on margins, but we have to eke efficiencies out of our existing business and our back book to be able to fund some of that. If the tax change had not happened, the margins would have gone up. No question about it. Given that the tax change has happened and it is taking a little bit more time, while HDFC Life has fared in the first 2 months 2x or 3x, depending on versus private sector or overall industry, we have fared on every metric, whether it is in terms of new business growth, whether it's in terms of group growth, or whether it's in terms of number of policies or even protection. We have done well versus sector. However, it is lower than the typical run rate. However, we are carrying the costs of a full-fledged run rate of typically maybe 17-18%. So against that, we are trending as of now at, like I've guided, somewhere around mid-teens. So naturally, there will be pressure on margins only because of the removal of taxation. But if you take a slightly longer term view over the next year or so, once this year is out of the way, the upward trajectory on margins will continue to happen.
Back with closing trades right here on ET Now, and just want to mark what's happening across the globe, because that's also where you're seeing a bit of a steep fall. If you take a look at what the DAX is up to currently, that's down about 100 points, a little soft for FTSE. CAC as well as FTSE MIB are all trailing in the red as we speak. But I think the good news is on the flashes on your screen, it seems that monsoon will cover more parts of Chhattisgarh in about 2 days, and we're waiting for the onset, and may cover more of Maharashtra as well. I don't know where in Maharashtra it's been raining. All we've seen is just very sporadic showers here or there. And yes, Karnataka in the next 3 to 4 days. But anyway, the good news is that they're almost there. So that should cheer up the markets, if nothing else. We'll have Dipan Mehta as well join in on the show in just seconds from now. I can see Jay Bala as well waiting by. But Pramod, just in continuation with what we were discussing earlier before I let you go, just wanted to understand if there are any other ideas which you are at least observing or keeping on your table for whenever the market gives you the right opportunity.
Oh, there are always ideas. There are always ideas. Like I said, we are more bottom up. We take a long time to research on an idea and wait for the price to come. So we have a wish list, a shopping list there, where we've done research and waiting for it. But these are not specific to any theme, because like I said, if the theme works, it's a bonus. But it's not like we identify the theme first and then go hunting for ideas. But we do have quite a few where we're waiting for the right valuations to emerge.
Any niche consumption plays over there? Because what one is seeing is that it's the luxury market which has been booming, and some of the newer discoveries as well, they're within both in the mid and the small cap arena as well, continue happening.
Yes, I mean they're all across sectors, but our luxury play has always been Titan for a long time now, and that's continued to be one of the core positions in our flagship portfolio. We do believe there is a very long growth runway in terms of market share consolidation within the jewelry space, and Titan is clearly leading that consolidation. There's a large unorganized market out there. The average Indian is migrating towards branded, trusted names, given the urbanization themes and all. And Titan, or Tanishq in particular, should be a winner from a long-term perspective.
Titan should be a winner in the long term. Thank you so much, Pramod, for joining us with all that take on the markets. But let's welcome on board